Amrish Baliga, the COO of Way2Wealth. Amrish, thank you so much for joining us on the show. It's a pleasure to have you. Now, before we talk about the Infosys results, which we're going to get to in a little while, I want to talk about those IIP numbers. This month's number was disappointing. The revision on January's number was even more disappointing. There are a lot of analysts who are now saying this looks like the beginning of a slowdown. Could you explain to us what's going on exactly?
I mean, we also don't know what's going on, because if the numbers can be revised by that huge difference, I mean, they talked about 6 odd in January and now they're revising it to 1 odd. I mean, I really don't know as to how much to trust these figures. Yes, there's a slowdown, but I mean, changing figures like this is something which is just not acceptable. I don't know how the international investors will read this.
The finance minister came out on Thursday evening and said, you know, the RBI is going to have to take some steps now, and that's the only way we can revive growth in the country. So the two questions here. One, if, like everybody else, if the RBI feels that this number might be revised next month, then it might not want to react. Right. But in your opinion, what do you expect the RBI to do next week? I
mean, first of all, this statement clearly shows its helplessness. And yes, I think RBI will have to act. But I don't know whether RBI will act on April 17th. Even if they act, may not be more than 25 basis points. But yes, I think if they do that, there will be some sort of a trigger. But if you're talking of the rest of the year, going ahead, yes, I mean, we clearly expect a 75 to 100 basis points cut in the repo rate. And that should be a good trigger enough going ahead.
If you're expecting those rate cuts to come in, then we need to talk about banking, auto and real estate. Where do you see these three sectors moving towards the end of the year?
Banking sector, if you're talking of the rest of the year, yes, I do see banking and auto performing. Realty could see some upward movement because of the rate cuts, but may not sustain, because the underlying, which is the property prices, especially in Delhi, NCR and Mumbai, I mean, we still expect them to correct, because if you really look at the demand at the ground level, which is not there. And once that happens, you'll actually see the stocks even correcting further. As far as the banks are concerned, we are positive on the private sector banks. And I mean, even from these levels, I mean, although we see some correction, if you're talking the next 1.5 to 2 months, we see some correction in banks. But then overall, I think it should give you a return of about 20-22%. Autos, yes, selectively, we are quite positive. I mean, I would still look at a Maruti, but on a correction. Tata Motors, possibly at levels of closer to about 250, 260, I think one could look at that. Ashok Leyland, even at the current levels, is looking good. So I think these are the stocks to be in, but just wait for a small correction.
I want to bring you back to banking now. Ideally, the big banks would have made sense to pick it up towards the end of last year, November, December, when we saw them being available at very good valuations. For those of our viewers who didn't buy banking stocks back then, do you think it makes sense to pick up right now, before the rate cut actually turns and before the end of this year? Could you name a couple of stocks that you think make sense at these valuations? No,
I mean, when you're thinking of buying now, I would say possibly wait for the monetary policy, because the sort of run-up which we have seen in the past couple of days is taking into account that there will be a 25 basis points cut. If it happens, well and good. But if it doesn't happen, look at the flip side. You could actually see a correction in the banking space, at least for the next fortnight or so. Utilize that opportunity and buy.
All right, this is interesting advice. Keep an eye on the RBI next week during that meet, and if there isn't a rate cut, then we'll see banking correct a little bit. That's a good opportunity for us as retail investors to pick up banking stocks for the long term. Let's talk about Infosys. We know the numbers came out on Friday. The guidance disappointed the market. How are you reading into this right now? For the rest of the year, where do you see Infosys going?
In just one sentence, I could say that possibly the best is behind them as far as Infosys is concerned, and IT sector overall. I mean, if you're talking of the larger players, because with the sort of growth prospect which is there, I mean, at least the foreseeable future which the Infosys management has guided for 8 to 10% sort of a growth, why should you pay premium valuations which the market has been giving them for the last 10 years? So this actually, you'll see a decent correction even from these levels. In fact, in the next couple of weeks, we could see Infosys possibly at levels of closer to about 2200.
2200 on Infosys. This is interesting, Amrish. I want to take some time to talk to you about this. We have a lot of retail investors who feel need to have an Infosys or a Wipro or a TCS in their portfolios because they think it's a strong, big company, it's not going to go anywhere. But you said you barely see it giving us 8 to 10% in the long term. Tell us, do you think it makes sense to have these stocks in our portfolio right now, or are there better options there other than the IT pack?
I mean, there are two reasons why you generally pick up a particular stock in your portfolio. One is the security aspect, and the second one is the returns. Yes, Infosys will possibly give you that security, but may not really give you the returns if you're talking of at least the foreseeable next 1 or 2 years. I think the way to look at it is would be compare it with Hindustan Unilever, which was the darling of the markets, which gave you extremely good returns in the 80s, the 90s. But what happened between 2001 and 2010? I think something similar could happen for Infosys, and that's the reason I said I think the best is behind them.
So for those viewers right now who are holding Infosys stock or maybe even TCS in their portfolio, what would be your recommendation?
I think they should book out and possibly look for some other stocks which could possibly give them better returns, but at the same time would actually give them a decent amount of security.
All right, so look for opportunities to book out of Infosys and TCS. Amrish, of the opinion there that it's not going to give you the kind of run-up that you would expect from a stock, even though it does offer you a decent amount of security. All right, let's move on now to our portfolio segment. Now, every week we look at the portfolio of one lucky viewer and tell him how he should be tweaking his portfolio to make the most of the market. This week, Suraj from Bangalore has written in. He tells us he has 120 shares of Wipro, which he bought at 376. 1,000 shares of Ashok Leyland he bought at 31 rupees, and 320 shares of JP Associates, which he bought at 86. Now he's planning to hold these shares for the long term. He also wants to invest more, and he wants you to tell him how he can build his portfolio. You did say Ashok Leyland is a good buy,
right. But
when you look at these three stocks, would you like him to tweak something around?
Like I said, I think he should exit Wipro even before the results are out. Because again, if the results are in line with what we have seen in Infosys, which is possible because Wipro has gone through the restructuring, so don't really expect any great shakes in this quarter. And
he has made about 30 rupees on each share, so
absolutely.
He has a profit there.
So I think he should book out of Wipro. JP Associates, again, we saw a recent high closer to 86, 87 levels. And again, the triggers would be, again, their new cement plant, inauguration of the expressway. Because of these triggers, you could see some more bump up. But I think, closer to about 90, 94 levels, I think you should exit JP.
All right, Suraj, you need to be booking out of Wipro and holding on to the other two stocks. I'd like to bring up Maruti on your report card. Amrish, you recommended it to us when it was trading at 992 with a target of 1400 in 1 year. Now, that stock is currently at 1323, which is fairly close to its target price.
It in fact went very close to its target price, and from there it has corrected. And generally, like most of my picks, which are contrarian picks, I had recommended the stock when the whole market was selling it off.
So what would you recommend at this point? Investors who bought the stock when it was at 992, do you recommend they book some profits right now, or are you going to revise your targets?
No, I'm still not revised the target on my stock. It's still closer to about 1400. So at these levels, in case you see levels of closer to about say 1350, 1360, I think one should book out to a certain extent. All
right, book out on Maruti to a certain extent. If you see those values, remember the target on that stock was 1400 rupees. Let's move on now to the stock that Amrish is recommending for us this week. It's L&T. This has been one of your favorites for nearly 4 years now.
Absolutely.
L&T and BHEL has been on your list for 4 years. Tell us, at these current values, why does it make your list?
See, again, this is one of those very diversified infrastructure capital goods sort of player, which again provides you that security which we just discussed when we are talking of Infosys. But at the same time, it also provides you that growth. And the company which has about the next 3 years turnover is already booked. Yes, your margins have been under pressure to a certain extent, but then with the sort of a growth which we are seeing, and again, if you're talking of in terms of EPS, I'm expecting about 80 rupees for FY13. FY14, in fact, we are looking at levels of about 90 to 93. So looking at that, I suppose one should be able to get levels of about 1550, 1600 for the stock.
Now, this is a company that depends on industries like power, like infrastructure, like real estate to grow. And we've seen a slump in those industries over the last 1 year. They're also looking at that rate cut possibly for economic activity, all of that rolled into one. So it's sort of linked to the economy largely. Right. So when do you, there has been a certain amount of uncertainty as far as L&T is concerned in terms of A, the margins like you mentioned, B, the announcements of the project that haven't been coming as regularly over the last year. When do you expect all of this to change for the company?
No, like I said, the order book position is full for the next 3 years. So even if there's a slight amount of slowdown in project flow or the order flow, it doesn't really matter very much. And again, one of the major sectors is power. I mean, just look at what has happened now for Coal India. I mean, the government is acting, I mean, over time to ensure that there is enough amount of raw material supply for the power sector so that, I mean, we are not power deficit in FY17. So clearly, I think the power sector will come back in shape, possibly in the next 3 or 4 quarters, and that would be good for L&T.
And what are your targets for L&T right now for the long term?
This is a very long-term stock. If you can manage to hold off for the next 3 to 5 years, I think, I mean, this stock can easily give you that 25-30% of like return year on year.
All right, 25-30% return year on year from L&T. That's Amrish's first recommendation. It's time now to talk about the second stock he's brought for us this week. His growth pick this week is IRB Infra. It's one of the companies that stands to gain from the projects being awarded by the National Highway Authority this year. Tell us what your expectations are from the company, Amrish.
Basically, it's a pure play, pure highway play. And with the sort of order flows which will now start from NHI, which has already started to a certain extent, I think IRB will be one of the major beneficiaries. Again, the current year we expect an EPS of about closer to 14.815. And looking at that, it seems quite cheap at the current levels. In fact, we are looking at a target price of about 240, 250. But again, I would not say that this is an extremely long-term play like Larsen & Toubro, but surely it's the next 1.5 to 2 year play.
So as a retail investor, if I'm buying into a company like this, what are the risks involved? What should I keep in mind when buying this stock?
No, risks basically would be the order flows, which I mean, we have been expecting should be good even going ahead. In case the order flows taper off, yes, I think that's one big risk for IRB. And secondly, being a mid-cap company, management always is always
something you should keep your eye on. And in terms of me putting this in my portfolio, do you think there's a certain percentage of the portfolio it should be capped at, or how much would you recommend we buy of this stock?
I mean, I won't recommend more than 1.5-2% of a portfolio in a stock like this. I mean, if you're talking of Larsen & Toubro, I can easily tell you have at least 5 or 6% of your portfolio in Larsen & Toubro. But when you're talking of a stock like this, not more than 1.5-2.
It's time now for us to quickly take a few questions that have come in during the week. Shripati has written in, he has 100 shares of RCom stocks which he bought at 292 back in 2009. Now he wants to know if he should continue to hold this stock. We know the stock ended the week at 84 rupees. The company's got a nod from the Singapore Exchange for that listing. It's a very large listing. Do you expect it to recover the levels that he's talking about, or do you think that there's very little hope at this point?
At this point of time, there's very little hope. I think the only hope for the investors would be in case there is a takeover bid for the company. In that case, possibly you could see levels of about 110, 115. But I think going beyond that would be a bit difficult.
All right, so if you see levels of about 110, you should be exiting that stock. Sorry for the bad news. Our next question comes in from Manoj. He wants to buy Bharti Airtel, Kane India and Coal India with a 2 to 3 year time frame. He wants to know, is this the good level to buy those stocks? And what target should he have on it? So, long-term investor, what would you recommend?
Absolutely. I think these are the 3 stocks which we've been recommending for the last couple of months. And yes, I think these are the good levels to buy. But surely keep some money for lower levels because, like I said, we are expecting the markets to correct further from here. And when the markets correct further, you can expect these stocks to be available at slightly lower levels. So, Bharti, again, at the current levels, and then look at levels of about 310 to buy more. Kane India similarly could fall either 3 or 4% more from here. Pick it up at those levels. Coal India, 310, 320. I think you should buy.
So, in spite of the fact that it's signing the FSAs with the power companies, you still think Coal India makes a good buy at this point?
Yes, no doubt, because that's already there in the price to a large extent. Because there has been a spate of adverse news for Coal India in the last 4 or 5 months, and we have seen the stock correcting from those 380, 400 levels to the current levels. So, it's already there in the price.
All right, so all of those are good stocks, and you heard the new targets on all those stocks. Good luck with that investment. Our last question comes in from Syed. He has 228 shares of ONGC, which he bought at 281 rupees. He wants to know if he should hold or sell. That stock ended the week at 260. What should he be doing with ONGC?
As long as the subsidy burden is there, which I think is going to be there for quite some time more, it doesn't become a fundamental buy. But yes, it's a trading bet. It moves between those levels of 355 to 255 to 285. So he should look at buying closer to 260, exit at closer to 280, 85 levels.
All right, so that's the call on ONGC. Unfortunately, we've run out of time on this show. Thanks for tuning in. Remember, you can send in your stock portfolios and your questions to the email ID that's at the bottom of your screen. Amrish, always a pleasure to have you on All About Stocks. Thank you for taking the time out. You can also reach us on our Facebook page as well. Thanks for watching.